The way a CFP professional, in my opinion, should approach life insurance is the same way they approach every other asset. The industry, I know because I was in the industry has a habit that does not serve clients' best interests of developing a product that is very attractive in a particular environment, but then because the things that I'm about to talk about weren't considered, it ends up not working out in many client situations. So, and let me give you an example of that flavor, what I call the flavor of the day product orientation from the insurance industry. In the 1970s, there were only two types of products in the 1970s, whole life and term. That was it. In the 1980s, a product, the universal life product was literally invented. And it provided an alternative to whole life. Some would say, I would say, somewhere in between whole life with a fixed premium for life and lifetime coverage, and term, also with a fixed but much lower premium for a slice of time. And universal life could be designed, and the whole word universal is, it's universal. It can be, you can fund it at different levels, you can change your funding, you can have it funded for different coverage durations. So it's somewhere in between whole life and term. In the insurance business in the 1980s, interest rates in the 1980s were high, 10, 12, 15%. Those were the prevailing interest rates. Those weren't stock market returns. Those were the prevailing interest rates. And the way insurance companies market their products is they run these things called illustrations or proposals. And regulations are such that insurance companies are not only able to, they're required to run whatever the current interest rate is. So if current interest rates are 15%, then the insurance companies run their calculations. They calculate their cash values at 15%, as you might imagine. If the growth of any account is calculated at 15%, it's going to be a lot bigger than an account that's calculated to grow at 5%. The inverse is also true. If you calculate the premiums needed to cover costs over the life of the policy, assuming that those premiums are going to earn 15% and cover a lot more of the cost, premiums are going to be a lot lower than if the premiums were calculated assuming that the account values would be credited with 5%. So this flavor of the day product is the industry develops products that illustrate well in the current environment. So in the 1980s, universal life looked a lot better than whole life. And there was a lot of activity to exchange a perfectly good whole life policy for a universal life policy because it looked better. But whole life policies and universal life policies, by regulation, are required to invest in the same asset classes. So even though some illustration might say that you're going to get 15% because that's what the illustrations regulations say, if they're invested in the same asset classes, you're going to get the same return. So the approach to a prudent selection or retention and proper management of life insurance is the same as every other asset on the client's balance sheets. What's the time horizon? Well, life insurance in general is a longer time horizon. But if it's 10 years, that's definitely one product type. If it's lifetime, it's another product type. But what's the time horizon? What's the asset allocation that's appropriate for the client's risk tolerance? What's the rate of return that corresponds to that, that's reasonable to expect from that asset allocation? And what does the client expect? Rate of return, asset allocation, time horizon, and expected outcomes. That's the way I think about every asset on the client's balance sheet. And so That's the way I think you should think about life insurance. So if you think if you thought about life insurance that way in 1985, and you said, okay, I'm in a whole life policy, and I got this proposal for a universal life policy, what's the rate of return that's reasonable to expect from that universal life policy over time? Not at this singular point in time, but over time. It's going to be the same as a whole life policy, and you would never make that exchange unless there was some other nuanced reason to make an exchange between whole life and universal life. In the 1990s, when the stock market was going crazy in the approach to the dot-com boom, there was significant activity in the industry to say, you shouldn't be in this, because by that time interest rates had fallen down, you shouldn't be in this low interest rate product, you should be in this product that can get 15% again or 12% again. So there was a lot of exchange, again, from a product that illustrated better, that the proposal looked better. But so a variable life product, I'm sure most of you, or if not all of you know, a variable life product allows account values to be self-directed into a family of mutual fund-like accounts, like a 401k. A whole life product and a universal life product is required by regulation to invest assets underlying cash values in high-grade bonds and government-backed mortgages. So fixed income only. So if you're going to go from a product that's fixed income only to a product that has a significant equity allocation, the first question you got to ask is, what's the client's risk tolerance? Not, does the illustration look better? What's the client's risk tolerance? So that question was not asked enough in the 1990s. Then in the 2000s, after the dot-com boom went to the dot-com bust, there was another movement to move clients out of variable products into guaranteed universal life, back to the fixed income type environment. There's actually a legal case called Cochran v. Key Bank. Google it, you'll read about a single client who went from whole life universal life to variable life to guaranteed universal life, and the outcome was not good at all. And today the current flavor of the day product is indexed universal life, where again, insurance companies are permitted to generate these quotes or these illustrations or these proposals using rates of return that may or may not be achievable and may or may not be consistent with the client's risk tolerance. So I would approach prudent selection and proper management, prudent selection or retention of insurance products and proper management of insurance products the same way I approach every other asset on the client's balance sheets. What's their risk tolerance? What's the asset allocation corresponding to their risk tolerance? What's the time horizon over which we're looking? And what's the outcome that's reasonable, or the expected outcome? And there's an acronym for that I use, RATE. The rate of return reasonable to expect, the asset allocation corresponding to that rate of return, the time horizon, and the expected outcome. Insurance companies discouraged whoever is licensed with them, they discourage replacements. Replacements are bad. It's a bad thing. You know, you've already paid acquisition costs. It's a bad thing. Replacements are always bad. Many CPA or tax attorney will also say that a replacement is bad because they also think about the commission that was paid and that it's not in the client's best interest. But again, it comes back to what's in the client's best interest are costs that are justified, performance that's reasonable to expect, and risks of underperformance that are consistent with the client's risk tolerance. So if there's a product that has high costs and the premium is not the cost, saying the premium is the cost of the insurance, unless it's term, but the premium of a universal life, a variable life, a whole life, or a indexed universal life, saying the premium is the cost is like saying that the $2,000 you put into your IRA is the cost of the IRA. That's silly. The cost of the IRA is what they take out of your $2,000. The cost of the insurance is what they take out of the premium, the universal life premium, the whole life premium, the indexed universal life premium, or the variable life premium. So you got to know those costs. That was the epiphany for me for creating Veralytic, because when I was in the pension investment advisory department, we would look for low-cost funds. How did I do that? Mutual fund companies weren't jumping all over themselves to tell me that what their costs were. It was an independent source of that information, like Morningstar, that I used. So if costs are high, then, and there are acquisition costs that will be paid on any exchange. So you got to make sure that if costs are high and you can move that account to a lower cost provider, you got to make sure the cost savings are more than enough to offset the transaction costs of doing that exchange. But if costs are high and you can get to a lower cost environment, you can't tell me that's not in the client's best interest, right? If they're in a, many a college student is sold a whole life policy without ever asking their risk tolerance. I know that if somebody had not asked me my risk tolerance and sold me a whole life policy in my 20s, I would have been upset in my 50s, because I would have missed out on all that growth that I could have had in a variable policy. So same process as every other asset on the client's balance sheet. Is an exchange in the client's best interest? What are the costs? Are costs justified or are they excessive? What's the rate of return that's reasonable to expect? Both in terms of the performance and in terms of the asset allocation appropriate to the last piece. What's the client's risk profile? What's their tolerance for short-term underperformance that they're going to have to live through in order to get better long-term performance? It is the absolute worst way to compare policies. That would be like you're buying something on Amazon. You're buying a toaster on Amazon. And you find the 3 models you like, and there's a price beneath each one of them. But beneath each one of them is a disclaimer that says, we reserve the right to come back to you for more money at any time. How do you know what you're going to pay? And they don't tell you how much more they can come back for. Would you buy any toaster, any of those toasters, under that circumstance? Nobody would, right? That's what an illustration is. An illustration is, as I said a minute ago, the premium is not the cost. And there is great latitude that insurance companies have for calculating the premium using different rates of return that are sometimes disclosed, sometimes not disclosed, sometimes what I call under-disclosed in the proverbial fine print on page 65 of the illustration. Do not compare quotes. It is the worst thing you can do if you're a fiduciary, not just because it could lead to a bad outcome for your client, but fiduciaries have a general duty to justify costs. Well, if the premium is not the cost, you're in breach of that duty. They have a general duty to evaluate the reasonableness of performance expectations. Well, if the illustration doesn't actually disclose the actual performance requirements, you're in breach of that duty. And in comparing illustrations that have these different rates of return, you're inherently not matching up the risk profile of the product with the client's risk tolerance. So it is the worst thing you can, unless it's term insurance, the worst thing you can do as a fiduciary is compare hypothetical illustrations. So, okay, well, that's a softball for me and my company. I mean, the way I did it when I was in the pension investment advisory business is, instead of trying to read 200 prospectuses on all the mutual funds that might be out there suitable to that plan, I would subscribe to Morningstar and I would get the answer in minutes or seconds. I thought that was a good idea for insurance products. So that's an easy way to do it, but at a minimum, at a very minimum. Let's say you go to work for a firm who doesn't believe that or whatever. At a very minimum, these illustrations, they are useful for a number of things. I'll come back to some other things that are useful. But those hypothetical premiums are calculated based on numbers that are available. Those premiums are calculated based on the costs that the insurance company has filed with the state departments of insurance. It's based on the performance assumptions or requirements, as the case may be. I mean, they call it, the insurance industry calls it an assumption, which makes it sound acceptable, but it's a requirement. If you want that premium, that performance is required. So there are pages inside the illustration that you can get for all types of products, except for whole life. I can come back to that. But ask for these disclosure pages, commonly referred to as detailed expense pages, policy accounting pages, but you'll know them when you see them because they show year by year, here's what the premium loads are, here's what the expenses are, here's what the cost of insurance charges are, and here's what the interest that the policy has to earn in order for the client to be, in order for that illustration to meet the client expectations. So absolutely positively, if you take nothing else away from this and you touch a life insurance policy, insist on those detailed expense pages. For whole life products, you can ask the insurance company to have the actuary manually calculate it, but the only practical alternative is getting a Veralytic report. A Veralytic report will tell you what the costs are and what the performance requirements are. Sure. The type of product that is suitable to the client's best interest is a function of that rate acronym I mentioned before: rate of return, asset allocation, time horizon, and expected outcome. But what I don't think is, with the CPAs and tax attorneys that I talk to, what is not well understood is that different products are required to invest in certain asset classes. And I remember from my days in comprehensive financial planning and working in the pension investment advisory department, study after study shows that asset allocation has more to do with the actual outcome than does individual security selection or policy selection for that matter. So choosing the right type of product is more important than going straight to picking a particular product. So for instance, if the client is, if the need for insurance is less than the client's life expectancy, it's almost, and it's for risk protection or family protection or business protection, it's almost always term insurance. I mean, there are exceptions to every rule, but it's term insurance. So if somebody says that whole life is better or universal life is better, really think that through. If the need is less than life expectancy, it's term insurance. And the reason for that is insurance companies don't issue term insurance beyond life expectancy. So they only need to collect enough premium to pay out half the claim, half of the whole life claims, right? Because if you're only, life expectancy is when half the people have died and half the people are alive. So if the insurance companies for term insurance only need to collect half or less of the premium, premium's always going to be less, a lot less than the premiums on permanent insurance. If the client has a conservative risk tolerance, whole life and universal life policies are required by regulation to invest predominantly in high-grade bonds and government-backed mortgages. Regardless of what some illustration says that they can get 8%, I don't know how they're going to get 8% out of high-grade bonds and government-backed mortgages, but you and I have already talked about the disconnect between illustrations and the reality of modern portfolio theory. If they're a more aggressive investor, you want to be able to allocate to equities. If you have a higher risk tolerance, you want to be able to allocate to equities. So that would be a variable product. And then if you're somewhere in between aggressive investor or conservative investor, then an indexed universal life policy could certainly be worth consideration. However, indexed universal life policies currently have more disparity in costs than any other product type. So, and more shenanigans on the illustrations. So, if you think the client is in a conservative risk tolerance, has a conservative risk tolerance, and so you're thinking about IUL, again, make sure you get those detailed expense pages or the policy accounting pages, whatever those pages the insurance company calls, that show year by year disclosure of costs and performance requirements.